Picture Jesse Livermore at 14, fleeing a Massachusetts farm with nothing but an uncanny ability to read stock prices, destined to become Wall Street's most feared speculator, and the man who would pocket $100 million during the 1929 crash, equivalent to $1.5 billion in today's money. Yet here lies the paradox that explains why 90% of traders lose their shirts before the lunch bell rings. Livermore's legendary fortunes came not from pouncing at the opening bell like a starved predator, but from waiting through the market's noisiest, most deceptive hours with the patience of a master chess player studying his opponent's every move. His brutal education in the bucket shops of the 1890s taught him what modern traders still refuse to accept. The opening minutes represent what he called a liquidity mirage, and unpaired orders rather than genuine supply and demand forces that create lasting trends. While amateur speculators mistake this morning volatility for golden opportunity, seasoned professionals recognize it as a carefully disguised minefield designed to separate fools from their money with surgical precision. The mathematics are unforgiving and haven't changed in over a century. Livermore identified 3 morning execution traps that consistently destroy trading accounts before most people finish their first cup of coffee. The gap, chasing euphoria, snares traders who buy strength at the exact moment when early buyers begin taking profits, purchasing at peak effort rather than confirmed demand. The tight stop massacre harvests those who place protective orders within the opening range's natural noise, getting whipsawed by routine liquidity sweeps that have absolutely nothing to do with genuine directional bias. The news overreaction trap punishes traders who confuse sensational headlines with actionable market intelligence, failing to distinguish between information that moves prices temporarily versus genuine catalysts that create sustainable trends worth riding. Livermore's transformation from chronic loser to market legend began with a crucial realization that would reshape his entire approach to speculation. The opening bell wasn't a starting gun signaling immediate action, but rather a test of patience and emotional discipline that separated professionals from gambling amateurs. His famous principle, "Don't fight the tape," didn't mean jumping on every price movement, but waiting for the tape to speak clearly through confirmed price action, rather than interpreting its early morning stutters as divine market wisdom. The statistical reality remains brutally unchanged after more than a century of market evolution. 70% of opening gaps retrace significantly within the first hour as the market digests overnight developments and establishes fair value through genuine price discovery, yet only 30% of retail traders possess the emotional control necessary to profit from this knowledge rather than become its latest victims. Livermore learned through painful experience that overnight orders pile up like traffic at rush hour. Market makers widen spreads to 3 to 5 times normal levels to protect themselves from information asymmetry, and a single large fund adjusting portfolio positions can swing stock prices 2% before the general public even realizes what is happening. Meanwhile, the human brain craves immediate closure and certainty, transforming speculative headlines into concrete conclusions and turning natural price fluctuations into urgent calls for action. This toxic combination of mechanical market forces and psychological pressure creates what Livermore recognized as the line of least resistance working in reverse. Early morning price action reveals the path of maximum trader destruction rather than profitable opportunity. He discovered that treating the first hour as a discovery process rather than a decision, the irony that would define his legendary career was learning that restraint and patience during the market's most volatile hours actually enabled more aggressive and profitable position taking later in the session when directional clarity emerged from the morning chaos. But understanding why the opening bell transforms into a wealth destruction machine requires examining the specific mechanical forces and psychological biases that turn routine market functions into trader traps. Which brings us to our next critical examination of exactly how these morning massacres unfold tick by tick. Jesse Livermore's bucket shop education provided him with a surgical view of the morning massacre, where he watched fresh capital arrive each day with unwavering optimism, only to be systematically dismantled by forces that most speculators never recognized, much less understood. The mechanical reality of market opens creates what Livermore learned to call a perfect storm of organized chaos, where overnight orders accumulate like water behind a dam. Stop losses triggered by after-hours developments, institutional rebalancing requirements, international spillover from overseas markets, and retail traders placing market orders based on yesterday's closing emotions or this morning's financial television commentary. When the opening bell releases this pent-up order flow, it crashes into a system designed for orderly price discovery during normal hours, creating violent price swings that have nothing to do with genuine supply and demand dynamics. Market makers, those crucial liquidity providers who buy what others want to sell and sell what others want to buy, protect themselves during these chaotic opening minutes by widening bid-ask spreads to 3 to 5 times their normal levels, essentially charging premium prices for immediate execution when uncertainty peaks and information asymmetry runs rampant. Professional traders understand this dynamic and adjust their expectations accordingly, while amateur speculators interpret these wider spreads and erratic price movements as signals of unusual opportunity rather than systematic friction that makes profitable trading exponentially more difficult. Single large institutional orders, whether adjusting portfolio positions or reacting to significant overnight news, can disproportionately distort price discovery during these thin opening minutes, creating artificial spikes or plunges that bear no relationship to the day's underlying directional bias or longer-term trend structure. Livermore's expensive early education revealed 3 specific failure modes that consistently destroyed trading capital during the morning hours with mathematical precision. The gap chase represented the most seductive trap, where stocks opening significantly higher on earnings announcements or breaking news attracted waves of momentum buyers who mistook price extension for confirmed strength, purchasing shares at the precise moment when early informed buyers began taking profits and distributing inventory into the enthusiasm. These late arrivals found themselves holding positions at peak effort levels rather than areas of genuine accumulation, discovering too late that opening gaps often represent emotional extremes rather than sustainable trend beginnings. The mean reversion trap caught traders on the opposite side of the same dynamic, where experienced speculators attempted to fade opening moves without understanding the crucial difference between routine noise that deserved contrarian positioning and genuine distribution or accumulation that signaled structural shifts ahead. Livermore learned through painful experience that not all opening extremes revert to fair value, and distinguishing between temporary imbalances and directional changes required patience and confirmation that most traders refused to wait for during the market's most exciting hours. The tight stop massacre proved equally devastating, as traders placed protective orders within the opening range's natural volatility, essentially guaranteeing their ejection from positions through routine liquidity sweeps that had absolutely nothing to do with their directional analysis or market timing. The psychological component amplified these mechanical dangers exponentially as traders arrived at their screens primed by overnight news consumption, social media sentiment, and the natural human tendency to impose narrative structure on random price movements. This mental preparation created confirmation bias that transformed neutral price action into supporting evidence for predetermined conclusions, while time pressure from the market's opening urgency prevented the careful analysis that successful speculation demanded. Livermore discovered that successful tape reading required emotional neutrality that was nearly impossible to maintain during the morning's sensory overload of flashing prices, breaking news, and the general excitement that accompanied each session's beginning. His transformation from chronic loser to legendary speculator began when he grasped that the opening bell wasn't a verdict on the day's direction, but merely a discovery process where the market tested various price levels to determine where genuine buying and selling interest existed. His famous principle, "Don't fight the tape," meant waiting for the tape to speak clearly through sustained price action, rather than interpreting its early stutters as definitive market wisdom. The statistical reality supported this patient approach with brutal consistency. 70% of opening gaps experienced significant retracement within the first hour as spreads normalized and emotional extremes gave way to rational price discovery. Yet only 30% of traders possessed the emotional discipline necessary to profit from this knowledge, rather than become its latest victims. Livermore understood that the human brain's craving for immediate gratification and its aversion to uncertainty made the opening hour particularly dangerous. Watching as others repeatedly fell victim to these predictable patterns driven by fear of missing out and the compulsive need for constant action. His genius lay not in predicting the chaos, but in respecting its inherent unpredictability and refusing to participate until genuine directional clarity emerged from the morning's routine destruction. But understanding these traps was merely the foundation for developing the systematic filters that would separate signal from noise and transform patient observation into profitable action. Jesse Livermore's transformation from bucket shop victim to Wall Street legend crystallized through his development of what he called the pivotal point system, a methodical approach that translated his hard-earned understanding of market behavior into precise rules for separating genuine opportunity from the morning's elaborate deceptions. His breakthrough insight revolutionized how he viewed market timing. Rather than reacting to immediate price movements like a gambler chasing cards, he would force the market to prove its direction through both time and price filters that demanded objective confirmation rather than subjective interpretation. This systematic approach emerged from a crucial realization that the opening bell represented a discovery phase rather than an opportunity phase, requiring him to treat the first 45 to 90 minutes as a laboratory where he could observe how the market absorbed buying and selling pressure while spreads normalized and early extremes faced their first real test from genuine participants rather than overnight order flow. The time filter became his first line of defense against morning chaos, a disciplined waiting period that wasn't passive observation, but active analysis of how support and resistance levels held or failed, and whether price movements occurred on expanding or contracting volume that would indicate genuine institutional interest versus mere mechanical execution of predetermined orders. His price filter demanded mathematical proof that supply and demand had resolved through specific pivotal points, where the market demonstrated commitment to directional movement rather than random fluctuation. Livermore formalized this approach through 3 sequential tests that eliminated guesswork and emotional decision-making from his speculation process. The first test required establishing the opening range by identifying the high and low points of the first 30 to 60 minutes, functioning like a battlefield map that defined the arena where buyers and sellers would wage their daily war. The second test demanded what he called effort-result alignment, watching for attempts to break the opening range that demonstrated volume surge of at least 1 and a half to 2 times average levels paired with decisive expansion beyond the boundary and minimal rejection back into the range. False breakouts revealed themselves through immediate reversal or volume that failed to expand meaningfully during the breakout attempt, signaling that the move lacked genuine participation and would likely collapse quickly under the weight of profit, taking or stop loss selling. The third and most crucial test required acceptance above or below the opening range, where pullbacks held cleanly above newly breached resistance levels for long positions or below broken support levels for short positions, proving that the market was absorbing shares at new price levels, rather than merely triggering stops or creating temporary imbalances. This acceptance phase validated the directional shift by demonstrating that any lingering supply had been absorbed on long breakouts, or that demand had been exhausted on short breakdowns, confirming that the path of least resistance had genuinely shifted in favor of the new direction. Only when all 3 conditions aligned, proper time elapsed, effort, result confirmation, and acceptance demonstrated, would Livermore initiate new positions, understanding that this systematic approach dramatically reduced his exposure to the random price movements that destroyed less disciplined speculators. He enriched this framework with relative strength analysis, requiring that breakout candidates outperform their sector and the broad market while displaying cleaner consolidation patterns than their peers, preferring stocks under quiet accumulation where the cause measured in weeks of base building could plausibly produce an effect equal to or greater than the risk required to own the position. The system's mathematical beauty lay in its if A and B, then C logic that neutralized the morning's social pressure to act by converting impatience into a systematic checklist. If the opening discovery phase completed and defined a clear range, and if a breakout occurred on superior effort with meaningful distance, and if acceptance followed through constructive retest behavior, then probability and payoff aligned sufficiently to justify risk. Otherwise, he would stand aside regardless of how compelling the story or attractive the setup appeared to his emotions. This methodology echoed his famous observation that he made his money sitting tight and doing nothing. Recognizing that the market rewarded patience and punished impulsive action with mathematical consistency that hadn't changed despite decades of technological advancement and market evolution, historical validation of these principles appeared dramatically during his legendary 1907 panic profits, where he observed weeks of distribution patterns in leading stocks, then waited for failed rallies to pivot the tape from vulnerable to definitively broken before initiating his first short positions, allowing the pivotal points to multiply as the market surrendered successive support levels, and confirmed his directional thesis with overwhelming evidence. The same logic operates in modern markets with identical precision, whether applied to 5-minute charts or daily timeframes, because the underlying psychology of fear, greed, and crowd behavior remains unchanged despite electronic execution and algorithmic participation. A stock opening with a 3% gap might establish a 2-point opening range during the first hour, experience an initial breakout attempt that spikes volume to 2.2 times average, but gains only a quarter point before snapping back inside the range, revealing effort without result, and signaling no trade opportunity, followed later by a second attempt after a tight consolidation that clears the range by a full point on expanding volume, pulls back half a point on light trading, and turns higher from the former resistance level, providing the acceptance that validates the risk and confirms the pivotal point. Livermore's final refinement integrated temporal discipline with his systematic approach, respecting the market's daily rhythm by recognizing that if his thesis hadn't proven itself through structure and distance by 11:30 in the morning, conditions were likely range, bound, or choppy, requiring him to reduce exposure and conserve capital and attention for afternoon sessions, when institutional participants typically revealed their true intentions through sustained directional moves. But while superior entry signals provided the foundation for profitable speculation, Livermore's real genius emerged through his position management techniques that transformed these small confirmations into fortune, making pyramids while others got shaken out by the routine noise that followed even the most promising breakouts. Jesse Livermore understood that identifying profitable entry points represented merely the audition for market success, while his revolutionary pyramid principle transformed these initial confirmations into fortune, making positions that could withstand morning volatility and maximize trend profits in ways that modern fixed percentage risk models completely fail to achieve. His fundamental insight challenged every instinct that destroyed amateur speculators, rather than committing maximum capital when uncertainty peaked at entry points. He would start with deliberately modest exposure and add to positions only when the market rewarded his thesis through sustained price movement, never averaging down on losing trades, but scaling into winners at mathematically predetermined levels that corresponded to structural confirmation points. This approach represented a complete inversion of typical trader psychology, where fear of missing out drove oversized initial positions and hope of recovery encouraged adding to losers, both behaviors that Livermore recognized as guaranteed paths to ruin during his expensive bucket shop education, where he watched countless speculators destroy themselves through these predictable emotional responses to market pressure. The architecture of his system rested on asymmetric initial sizing that risked only 25 to 50 basis points on first entries, regardless of conviction level, understanding that even the most compelling setups could fail due to unforeseen circumstances or timing errors that had nothing to do with analytical accuracy. This conservative approach allowed him to survive inevitable mistakes while preserving capital for genuine opportunities that would reveal themselves through sustained directional movement and volume expansion over multiple sessions. His stop placement protected against morning noise by positioning protective orders beyond critical structure rather than inside it, typically 1-to-1, and half times the opening range or average true range beyond invalidation levels, recognizing that tighter stops would be harvested by mechanical market functions rather than meaningful directional changes. While wider stops provided breathing room for normal fluctuation without compromising disciplined exit criteria when his thesis proved incorrect. The legendary cotton trade of 1908 demonstrated these principles in spectacular fashion, where Livermore transformed a modest initial probe into a $3 million winner, equivalent to $90 million in today's purchasing power, by adding at specific price levels as the commodity continued higher while maintaining structural integrity through constructive pullbacks that held above former resistance levels. He initiated the position with minimal risk after cotton broke through significant resistance on expanding volume, then added equal amounts at predetermined intervals, spaced 1-to-1, and a half-average true ranges apart, with each addition occurring only after the market proved its willingness to absorb supply at higher prices. His position size grew geometrically as probability shifted increasingly in his favor through price confirmation rather than hope or emotional attachment to his original thesis, allowing him to withstand violent rebounds that terrified competitors out of their positions while his mathematical structure kept his average cost favorable and his risk controlled. His temporal discipline became equally crucial through what he called the 11:30 rule, that recognized how markets typically declared their daily character by late morning when the opening discovery phase completed and institutional participants revealed their true intentions through sustained buying or selling pressure. If a breakout trade hadn't gained meaningful distance and demonstrated structural follow-through by this critical threshold, Livermore would reduce or exit the position, regardless of paper profits, understanding that afternoon sessions often reversed morning moves when volume contracted and price action became increasingly random and difficult to interpret. This rule prevented him from holding marginal positions through lunch or doldrums while conserving both capital and mental energy for afternoon opportunities when directional clarity typically emerged from the morning's chaos. The mathematical beauty of his approach appeared in how it aligned position size with probability rather than opinion, starting small when uncertainty peaked and growing larger as market confirmation reduced risk through sustained movement in the intended direction. Modern traders consistently reverse this logic, taking their largest risk when they know the least about market response, and reducing exposure precisely when probability has shifted most favorably through confirmed price action. Livermore's pyramid structure provided natural profit, taking discipline while allowing core holdings to ride extended moves that occasionally produced the outsized gains necessary to offset inevitable small losses from failed setups, creating what he called letting the market pay you for being right, rather than fighting against its natural tendencies. His system's psychological advantages proved equally important as its mathematical structure, providing objective criteria for position management decisions that eliminated the emotional chaos that destroyed most speculators during volatile conditions. Rather than agonizing over whether to add to positions or take profits, he followed predetermined rules based on price structure and volume behavior that removed subjective interpretation from critical moments when fear and greed typically overwhelmed rational analysis. The approach demanded patience during the building phase and courage during the holding phase, qualities that separated professional speculators from gambling amateurs who sought immediate gratification rather than maximum mathematical expectation over multiple trades, transforming routine morning noise from a position killing obstacle into manageable nuisance that couldn't derail properly structured speculation. But theoretical understanding of these principles means nothing without examining their performance during the ultimate test, when the greatest market crash in history would validate every aspect of Livermore's systematic approach through the most extreme conditions imaginable. The ultimate vindication of Jesse Livermore's systematic approach arrived not as a surprise, but as the final confirmation of a tape he had been reading for months. Watching distribution patterns emerge in leading stocks throughout the spring and summer of 1929, while newspapers proclaimed a new era of permanent prosperity, his tape, Reading Skills, identified the classic warning signs that smart money was quietly exiting positions. Rallies in glamour stocks like RCA and General Motors required increasing effort for diminishing results. Volume patterns shifted unfavorably on down days, and former leaders failed to hold their breakout levels during retests, all violations of his cardinal laws that suggested the market's internal structure was deteriorating despite headline indices reaching new highs. By October, the evidence had crystallized into mathematical certainty through his pivotal point analysis. The market had built massive cores on the distribution side, and the inevitable effect would be violent and sustained, requiring him to position short well before the general public recognized the danger. Black Tuesday's opening bell unleashed the most extreme test of his morning discipline principles. As gaps down 10 to 15% in blue, chip stocks created unprecedented chaos that transformed routine market functions into wealth destruction on an industrial scale. The mechanical forces that challenged traders during normal opens became exponentially more dangerous as overnight selling from international markets combined with waves of margin calls to create a liquidity desert where desperate sellers found few willing buyers at any price near previous closing levels, while market makers widened spreads to unprecedented levels and reduced position sizes to protect themselves from the information asymmetry that accompanied such violent conditions. Yet Livermore remained eerily calm, methodically applying his systematic approach in reverse, recognizing that his morning filters would identify failed relief rallies rather than successful breakouts, and his pyramid principle would add to short positions as the market confirmed weakness through sustained selling pressure rather than building long positions during accumulation phases. His preparation proved crucial as he had already established short positions through his pyramid system during the preceding weeks, adding methodically as each successive pivotal point confirmed the developing downtrend, allowing him to enter Black Tuesday with a properly structured position that could withstand the violent counter. Trend moves that destroyed over-leveraged speculators caught unprepared. When desperate buying attempts created brief relief rallies during the morning chaos, Livermore applied his three-question framework with surgical precision. Did the rebound draw genuine sponsorship with expanding volume? Did price gain meaningful distance from the lows? And did acceptance occur above former support levels that had been broken? Each failed rally provided identical confirmation signals as successful breakouts during bull markets, just operating in reverse. Effort without result. Volume that failed to expand meaningfully during recovery attempts, and immediate surrender of any gains back into weakness, proving that buying interest was being overwhelmed by relentless selling pressure from margin calls and institutional liquidation. His position sizing architecture, built through decades of painful experience, allowed him to withstand adverse moves of 5 to 10% that would have destroyed typical traders, understanding that even during the most directionally obvious market conditions, violent snapbacks could temporarily shake out improperly positioned speculators before the primary trend resumed with overwhelming force. The pyramid structure enabled him to add to short positions at precisely calculated levels using the same effort, result analysis that guided his long positions. Recognizing that each failed rally at progressively lower pivot points provided fresh confirmation for scaling further into profitable shorts while maintaining advantageous average prices and controlled risk exposure. His temporal discipline proved equally masterful as he recognized that the market's daily rhythm had shifted dramatically, with morning weakness extending into afternoon collapse rather than typical midday reversal patterns, requiring him to maintain positions through periods when he would normally reduce exposure during uncertain conditions. The mathematical precision of his execution generated approximately $100 million in profits equivalent to $1.5 billion in today's purchasing power, achieved not through luck or inside information, but through disciplined application of the same systematic principles that had guided his speculation for decades. His success validated every aspect of his methodology with brutal clarity. the morning filters that separated genuine directional moves from temporary noise, the pivotal point system that identified optimal entry and addition levels, and the pyramid principle that aligned position size with probability rather than opinion, allowing him to profit enormously from the market's most extreme conditions, while others suffered devastating losses through emotional decision making and inadequate risk management. The bitter irony of his greatest triumph was that it coincided with America's economic catastrophe, making him fabulously wealthy while millions lost their life savings, illustrating the market's fundamental indifference to human suffering and its systematic transfer of wealth from those who ignored structural warning signs to those who recognized and positioned for inevitable consequences. This paradox transcended immediate profit and loss, demonstrating that markets reward those who respect their power and punish those who fight their direction regardless of personal opinions or social pressure, validating his core philosophy that successful speculation required constant alignment with market forces rather than fighting against them. Principles that would prove equally relevant for modern traders willing to embrace systematic discipline over emotional impulse. Jesse Livermore's enduring legacy crystallizes into a systematic morning survival protocol that transforms his century of market wisdom into immediately actionable steps for modern traders, proving that the fundamental forces destroying 90% of accounts before noon remain unchanged despite technological advancement and algorithmic participation. His transformation from bucket shop victim to Wall Street legend provides the blueprint for navigating the same treacherous opening hours that continue to separate professional speculators from gambling amateurs through mathematical precision rather than luck or intuition. The protocol begins with 20 minutes of pre-market preparation that treats each session like a military operation requiring intelligence gathering rather than reactive improvisation, spending the first segment identifying overnight themes through futures action and international spillover, 10 minutes marking critical support and resistance levels from previous sessions, while not in obvious liquidity pools around round numbers, and 5 minutes establishing daily risk limits that prevent catastrophic losses during unexpected volatility spikes that violate technical assumptions and destroy monthly performance through single impulsive decisions made under emotional pressure. Opening hour discipline represents the protocol's core defense mechanism, demanding absolute restraint from new position initiation for 45 to 90 minutes until the discovery phase completes and genuine supply, demand dynamics emerge from overnight. Order flow chaos, unless setups meet every criterion of Livermore's systematic approach with overwhelming mathematical confirmation. This waiting period requires active analysis of how the market absorbs buying and selling pressure, whether breakout attempts demonstrate effort, result alignment through volume expansion of at least 1.5 times average levels, and if pullbacks hold constructively above former resistance or below broken support, proving acceptance rather than mere stop running by market makers protecting themselves during uncertain conditions. The discipline transforms the opening bell from a trigger for immediate action into a laboratory for studying market character, recognizing that patience during these crucial hours prevents the impulsive trades that destroy accounts through catastrophic decisions made when fear and greed overwhelm rational analysis. Execution. Rules eliminate guesswork from critical moments by starting with half-normal position sizes on initial entries regardless of conviction level, understanding that even compelling setups can fail due to unforeseen circumstances that have nothing to do with analytical accuracy. Stop placement must account for morning volatility by positioning protective orders 1-to-1 and 1/2 times the opening range or average true range beyond meaningful invalidation levels, providing breathing room for routine fluctuation while maintaining disciplined exit criteria when directional thesis proves incorrect. Adding to positions occurs only when the market rewards initial risk through sustained movement and structural confirmation, never averaging down on losers, but scaling into winners at predetermined pivotal points where probability shifts increasingly favorable through price acceptance and volume expansion that validates the directional thesis. The critical 11:30 review serves as the protocol's temporal checkpoint, requiring honest assessment of session character to classify whether conditions favor trending, range-bound, or choppy behavior that demands different tactical approaches. Positions that haven't gained meaningful distance or demonstrated structural follow-through by this threshold require reduction or elimination, regardless of paper profits, conserving capital and mental energy for afternoon opportunities, when institutional participants typically reveal true intentions through sustained directional moves rather than morning adjustments and mechanical order execution that creates artificial price distortions. Psychological self-monitoring proves equally important as technical analysis, recognizing that successful speculation requires constant awareness of emotional state and the courage to do nothing when market conditions offer no clear advantage, understanding that the compulsive need for action during exciting periods typically produces the worst trading decisions and most expensive mistakes. This framework prioritizes capital preservation over entertainment value and mathematical expectation over emotional satisfaction, creating systematic discipline that transforms morning chaos from wealth destruction into competitive advantage for those willing to embrace patience over impulse. The mathematical reality supporting this approach remains constant because underlying psychology of fear, greed, and crowd behavior transcends technological change, making Livermore's insights as relevant today as they were during his legendary career spanning the early 20th century's most dramatic market cycles. Modern traders applying these principles discover that restraint during opening volatility actually enables more aggressive and profitable position taking later in sessions when directional clarity emerges from the systematic destruction of unprepared speculators, proving that successful speculation remains fundamentally a battle against human nature rather than market complexity. Livermore's morning discipline protocol offers the same edge that generated his legendary fortunes, demanding only the courage to embrace proof over hope and systematic patience over emotional reaction, transforming the opening bell from a trigger for impulsive decisions into a test of professional discipline that separates long-term winners from the 90% who consistently lose before noon. The ultimate lesson transcends immediate profit and loss, teaching that markets reward those who respect their power while punishing those who fight their direction, regardless of personal opinions or social pressure, proving that control over oneself, rather than control over markets, represents the true foundation of sustained speculative success. In our next exploration, we'll examine how these principles perform during bear market opens and gap downs, when patience feels most expensive but proves most valuable.